Right now, while most Americans are watching equity markets pull back, energy prices climb toward triple digits, and the Federal Reserve weigh its next move. Something far more significant is unfolding completely out of view. The most informed money on the planet, central banks, billionaires, sovereign wealth funds, and the institutional investors who move markets before you ever see them move, is quietly repositioning wealth outside the traditional banking and brokerage system, not into cryptocurrency, not into speculative commodity bets, into five specific vehicles that are completely legal, government-sanctioned, and available to any American with a few $100s and an internet connection. And the reason they are doing this right now, in March 2026, is not coincidence. The convergence of the overseas energy disruption, the commodity price surge, the return of sticky inflation, and a rate-locked Federal Reserve has produced the exact environment in which the traditional financial system stops protecting the people who depend on it most. I am going to show you all 5 exit routes, exactly how each one works, what each one costs, where you access it, and why the window to act is closing a little more every single week. First, let me be precise about what moving money outside the system actually means. This is not about anything illegal, not tax evasion, not hidden accounts. Every strategy in this video is regulated by a federal agency, explicitly permitted by the United States government, and used every business day by the wealthiest and most sophisticated investors on Earth. Moving outside the system means moving your wealth into vehicles where other parties do not hold risk against you. Your bank savings account is the clearest example of what you are moving away from. Most people treat it as a safe place. Technically, it is a loan you are making to the bank. The bank lends your deposit to other borrowers and pays you whatever rate it has decided is acceptable. If the bank experiences insolvency, FDIC insurance covers you, but only up to $250,000 per depositor per institution. The brokerage account has a different vulnerability. Every dollar you hold in equities is exposed to every automated sell program, every margin cascade on a rough week. The S&P 500 printed a 2026 low at 6,632. The Nasdaq broke its 200-day moving average. Goldman Sachs confirmed algorithmic strategies are positioned to reduce exposure in every market scenario right now. 40 million Americans with margin accounts are one sustained sell-off away from mandatory position reductions. The 5 strategies I am about to show you move portions of your wealth into vehicles where no bank can lend it, no algorithm can reach it, no margin desk holds a claim on it, and no market correction can reduce its face value. Strategy number 1. Raw land, purchased outright with cash. No bank involved, no mortgage, no lender with a claim on the asset. This is one of the most overlooked wealth preservation strategies in existence because the financial industry earns nothing when you use it. There is no fund to manage, no ETF to sell you, no advisor commission. Just you, a deed, and a piece of land that nobody can margin call, repossess, or algorithmically liquidate. When you purchase land with cash, what you own is a hard asset with zero counterparty risk. A stock requires a company to generate earnings. A bond requires a borrower to stay solvent. A bank deposit requires the institution to remain operational. Cash-purchased land requires nothing from anyone. The title is yours. The land cannot go to zero. The land cannot be frozen by a regulator. The land cannot be sold out from under you by an algorithm. Family offices and ultra-high net worth households have allocated to raw land for exactly this reason for generations. It is not about appreciation, it is about permanence. An acre of rural land in a stable county is one of the few assets that has never been worth zero in recorded American history. Current data: the USDA reports that U.S. farmland values increased 7% in 2025, the 4th consecutive year of appreciation. Rural land in commodity-producing states, the Midwest, the Plains, the Southeast, has outpaced inflation in every one of those 4 years. Here's how you access this. Rural land in lower-cost states sells for $1,000 to $5,000 per acre in many counties. County tax deed auctions. online land marketplaces like LandWatch and Land and Farm, and rural real estate brokers are your access points. Look for unencumbered parcels with clear title and no liens. Have a title search completed before purchase. Take the deed in your name, free and clear. The honest limitation: raw land is not liquid. Selling takes weeks or months. It generates no income unless developed or leased. It requires annual property tax payments. This is why raw land works as a small permanent allocation of 5% to 10% of total holdings, not an active trading position. The asset of last resort that requires nothing from the financial system to retain its value. Strategy number 2. Direct physical ownership of gold and silver, held by you, not inside any financial institution. This is the oldest wealth preservation mechanism in human history, and in March 2026, it is more strategically relevant than it has been in over 50 years. Gold closed Monday at $499,999.88 per ounce, a gain of roughly 19% since January 1st. Gold has outperformed the S&P 500, the Nasdaq, bonds, real estate, and cash year to date. JP Morgan targets $5,000 per ounce by the fourth quarter of 2026, with a specific scenario where just 0.5% of foreign-held U.S. assets rotate into gold, driving the price to $6,000. Goldman Sachs publishes a year-end target of $5,400. The World Bank projects precious metals reaching new all-time highs in 2026, following an estimated 41% gain in 2025. But the price forecast is not the reason this strategy belongs in the conversation. The reason is the nature of the asset itself. When you own physical gold, you own something with zero counterparty risk. No institution has to honor a promise for that gold to hold its value. The institution can become insolvent. Your gold does not care. The brokerage can face a liquidity event. Your gold does not care. The equity market can correct 50%. Your gold does not care. This is exactly why central banks are accumulating physical gold at a pace with no parallel in modern financial history. The World Gold Council reported central bank purchases of 1,082 tons in 2022, 1,037 tons in 2023, and 1,045 tons in 2024. 3 consecutive years above 1,000 tons, more than double the pre-2022 decade average of 400 to 500 tons annually. Monthly purchases into early 2026 average approximately 60 tons per month, more than triple the pre-2022 pace. Let that number land for a moment. The institutions that literally print money are converting that money into physical gold at 3 times the rate they did 4 years ago. Not ETFs, not futures, physical gold stored in their own vaults. The People's Bank of China added 1.2 tons in January 2026 alone, bringing total holdings to 2,308 tons. Poland ranked among the largest buyers of 2025. India, Turkey, and Brazil all grew their reserves significantly. And the structural outcome of this buying, gold has overtaken the euro as the second largest reserve asset on Earth, trailing only the US dollar. The dollar's share of global foreign exchange reserves has fallen to approximately 40%, the lowest since 1994. Gold's share has climbed to approximately 30%, the highest since 1991. These institutions are not speculating on a price move. They are restructuring their reserves away from paper denominations and toward the one asset that cannot be debased by money printing, cannot be frozen by sanctions, and cannot be defaulted on by any government on Earth. Here is how you act on this. You do not need $5,000 for a full ounce. The U.S. Mint produces American Gold Eagle coins in 4 sizes: 1 ounce, half ounce, quarter ounce, and 1/10 ounce. A 1/10 ounce coin costs roughly $500 plus a modest premium. American Silver Eagles run $32 to $35 each. Entry starts at a few $100s. Buy from an established dealer operating for at least a decade, accredited by recognized industry organizations, with transparent pricing that clearly states the premium above spot. Take physical delivery. Store in a home safe deposit box, or private depository. The distinction between physical gold and a gold ETF is not a minor technicality. An ETF is a paper claim on metal held by a fund company. That company can restrict your access. Physical metal in your possession has no counterparty. That is the entire point. Most serious advisors recommend 5% to 15% in physical metals as a permanent allocation, not a trade, a foundation. Strategy number 3 is the one nobody in the financial industry wants to lead with because there is no commission in it for anyone. TreasuryDirect.gov is a website operated by the United States Department of the Treasury. Any American citizen or resident can open a free account and purchase U.S. government securities directly from the source. No broker, no bank, nobody taking a spread. The flagship product is the Series Y Savings Bond. I-bonds are government-issued, inflation-protected instruments currently paying a composite rate of 4.03%, locked in for 6 months from the date of purchase. That rate has two components, a fixed portion of 0.90% that stays constant for the life of the bond, and a variable inflation component of 3.12% that resets every 6 months based on changes in the Consumer Price Index. Now check what your bank is paying you. The FDIC National Average Savings Account rate as of March 16, 2026 is 0.39%. That is not a typo. The average American bank is paying less than 0.5% on deposits, while the U.S. Treasury is offering more than 10 times that rate on I-bonds. Put that in dollar terms. A retiree with $100,000 in savings earns $390 per year at the bank average. That same $100,000 earns $4,030 at the I-bond rate. The gap is $3,740 every single year for doing nothing more than opening a free government account. Here is what makes I-bonds specifically powerful right now. The variable component reflects CPI data collected before the energy price surge hit consumer prices. February CPI showed headline inflation at 2.8% year over year, but oil has moved from $70 to nearly $100 per barrel since the overseas energy disruption began February 28th. Gas prices nationally surpassed $4. Diesel is at $4.16. Energy costs flow through to every product and service in the economy within 60 to 90 days. When the May 2026 I-bond rate reset occurs, it will incorporate CPI data from March through September, capturing the full downstream effect of the commodity price surge. If inflation runs at 4% to 5% annualized during that period, the variable component resets upward automatically. I-bonds purchased today at 4.03% could be paying 5% to 6% by November 2026, with no action required on your part. The inflation protection upgrades itself. Bonds cannot lose principal. Not in a market correction. Not when rates rise. Not in deflation. The rate floors at 0 and never inverts. The face value is guaranteed by the full faith and credit of the United States government. The purchase limit is $10,000 per person per year electronically. A married couple buys $20,000 annually. Direct your tax refund toward paper I-bonds and the individual total reaches $15,000. Redeem after 1 year. Redeem before 5 years and you forfeit the last 3 months of interest. After 5 years, no penalty. I-bonds earn interest for 30 years. Treasury Direct also offers Treasury bills yielding 3.6% to 3.7%, Treasury notes, tips where the principal itself adjusts with inflation, and floating rate notes, all held directly in your account. No fees, no commissions, no intermediary of any kind. Your bank does not want you moving money here because those deposits leave their balance sheet. Your advisor earns nothing when you use it. The system has no incentive to tell you this exists. That is the only reason most Americans have never heard of it. Strategy number 4 is where strategies 2 and 3 converge into the most powerful tax-advantaged wealth preservation structure available under current law. A self-directed IRA is a retirement account the IRS explicitly permits to hold physical assets beyond standard stocks and bonds. The IRS authorizes these accounts to hold American Gold Eagles, American Silver Eagles, Canadian Gold Maple Leaves, and gold and silver bars meeting defined purity standards. Here are the mechanics. You open a self-directed IRA with a custodian specializing in precious metals. Fund it one of two ways. Direct annual contribution up to $7,000 if under 50, or $8,000 if 50 or older, or roll over existing funds from a 401k, 403b, or traditional IRA. The rollover has no annual limit. There is no ceiling on the transfer amount. And here is the line that changes everything. A direct trustee-to-trustee rollover is not a taxable event. You can move $100,000, $200,000, or more from an existing retirement account into physical gold without triggering a single dollar of tax on the transfer itself. Once funded, you instruct the custodian to purchase IRS-approved metals on your behalf. The metals ship to an IRS-approved depository, a secured, insured, independently audited facility, not a bank, not a brokerage, a standalone precious metals vault. Your metals, allocated in your name, audited on a regular schedule, roll into a Roth self-directed IRA, and every dollar of growth from that point forward is completely tax-free. Not tax-deferred, tax-free. A retiree converts $200,000. The custodian purchases 40 ounces of American Gold Eagles at $5,000 per ounce. At Goldman's 5,400 target, $216,000. A $16,000 gain, tax-free. At the $6,000 JP Morgan scenario, $240,000. A $40,000 gain, tax-free. 3 layers of protection inside one structure. Physical metal with zero counterparty risk, stored outside the banking system entirely, growing permanently tax-free inside a Roth. Real costs: custodians charge $100 to $300 annually. Depositories charge $150 to $300 per year. Coins carry a 3% to 8% purchase premium. Bars run 1% to 3%. Compare that against a mutual fund charging 0.5% to 1% on your full balance, $1,500 per year on $200,000, while declining in value. Strategy number 5. Physical precious metals stored outside the United States in an allocated, government-regulated foreign vault. This takes everything you just learned about physical gold and adds one layer of protection that domestic storage cannot provide: jurisdictional separation. When you store physical gold in a U.S. facility, even a private depository, that gold sits within U.S. legal jurisdiction. It is subject to potential domestic regulatory action. In 1933, Executive Order 6102 required American citizens to surrender privately held gold. The order was later rescinded, but the legal mechanism existed. Allocated foreign vault storage removes that jurisdictional risk entirely. 2 of the most established programs available to American investors are the Perth Mint Certificate Program in Australia and private allocated vault storage through Singapore Freeport facilities. Both are government regulated, both are independently audited, both are fully legal for U.S. citizens, and both require IRS reporting. This is not a tax evasion strategy. It is jurisdictional diversification, the same principle sovereign wealth funds use when they store reserve assets across multiple countries. The Perth Mint is operated by the Government of Western Australia and is one of only 2 mints in the world with a A8A sovereign government guarantee on its certificate program. When you hold a Perth Mint certificate, you own a specific allocated quantity of gold stored in Perth, backed by the Western Australian government, accessible on demand, and completely outside U.S. domestic jurisdiction. Singapore Freeport vaults offer direct allocated storage in a jurisdiction with some of the strongest property rights protections on Earth. Singapore has zero history of confiscation, strong rule of law, and a government that has actively positioned the country as a global precious metals storage hub. Both programs require U.S. citizens to file an FBAR, a foreign bank and financial accounts report, if holdings exceed $10,000. This is a standard IRS disclosure form. Filing it is straightforward. Not filing it is a serious legal problem. As long as you report it correctly, this strategy is entirely legal. Perth Mint charges storage of approximately 0.15% annually. Singapore Freeport facilities run 0.12% to 0.18% annually, both significantly lower than domestic self-directed IRA storage fees for smaller holdings. Now, let me connect all 5 strategies to what is happening this week specifically. The Federal Reserve meets today and tomorrow. The market is pricing a 92% probability of no rate change. Goldman Sachs moved their rate reduction forecast from June to September. Some traders are now pricing 0 rate reductions for all of 2026. When the Fed holds rates while inflation is running above target, real interest rates go negative for ordinary savers. The New York Fed survey puts inflation expectations at 4.2%, the highest since the pandemic. Oil is at $99 per barrel. The IEA released 400 million barrels from strategic reserves, the largest release in the agency's 52-year history, and prices remain near triple digits. Every dollar crude stays above $85 adds CPI pressure in the following quarter. If oil averages $95 through mid-year, headline inflation could push above 3.5% by summer. The Fed's target is 2%. If inflation runs at 3% and your bank pays 0.39%, you are losing 2.61% of real purchasing power every year. $100,000 buys $97,390 worth of goods after year 1. $94,850 after year 2. After a decade, more than $23,000 in real purchasing power is gone, while the number on your screen technically grew. That is not a safe account. That is a slow, silent loss dressed in the appearance of stability. Here is what all 5 strategies look like applied together for a hypothetical 62-year-old with $350,000 in savings and retirement accounts. Step 1. They allocate $20,000 toward a cash purchase of rural raw land, a small parcel in a stable Midwestern county purchased outright through a county tax deed auction. No debt, no carrying cost beyond annual property taxes, a permanent asset entirely outside the financial system. Step 2. They purchase $15,000 in physical gold and silver through a reputable dealer, 1 10th-ounce gold eagles, a handful of full-ounce coins, and 100 silver eagles, delivered to their home safe, 0 counterparty, 0 fees, accessible the same day they need it. Step 3. They open Treasury Direct and purchase $10,000 in I-bonds at 4.03%. Spouse does the same. $20,000 total in inflation-protected, government-guaranteed principal that automatically resets upward as the commodity surge flows through to CPI. Exempt from state income taxes, earns interest for 30 years. Step 4. They roll $200,000 from their existing 401k into a Roth self-directed precious metals IRA. They pay the conversion tax at today's rates. The custodian purchases 40 ounces of American Gold Eagles at $5,000 per ounce, shipped to an IRS-approved depository. At Goldman's 5400 target, $216,000, tax-free. At $6,000, $240,000, tax-free. Step 5. They open a Perth Mint certificate account and allocate $15,000 to an allocated gold position stored in Perth under the Western Australian government guarantee. Filed on the annual FBAR, a second jurisdictional layer on their physical gold exposure, completely inaccessible to any domestic regulatory action. The remaining $80,000 stays in a high-yield savings account, earning 4% to 5% for liquidity, and in a brokerage account concentrated in energy producers and dividend payers that benefit from elevated commodity prices. No single event takes down the entire structure. An institutional insolvency event does not reach the land, the physical metals, or the treasuries. A market correction does not affect the I-bonds or the vault holdings. An inflation surge actively benefits the I-bonds, the gold, and the land simultaneously. And any domestic regulatory action on financial assets cannot reach the allocated position sitting in Perth or Singapore. The World Gold Council's 2025 survey. A record share of central banks expect global gold reserves to increase over the next 12 months. the highest institutional optimism in the survey's 8-year history. 95% of surveyed institutions expected holdings to rise. State Street's March 2026 Gold Monitor. Gold has been less volatile than Bitcoin by a factor of 4 over the past decade, less volatile than silver by a factor of 2, less volatile than the S&P 500 itself. Gold is not a speculative bet. It is the single lowest volatility alternative to fiat currency available in global markets. In 2025, global gold ETF inflows reached $89 billion, the largest single-year total on record. Assets under management doubled to $559 billion. Holdings peaked at 4,025 tons. January 2026 alone, $19 billion in inflows, the strongest month ever recorded. North America added $7 billion in January, extending a streak of consecutive positive monthly flows to 8. February added another $4.7 billion, stretching that streak to 9 straight months. U.S. dollar share of global foreign exchange reserves, approximately 40%, lowest since 1994. Gold share, approximately 30%, highest since 1991. Year over year, dollar reserves down 12%. Gold reserves up 40%. That is a structural realignment. The institutions that architect the global monetary system are telling you through their actual purchases that they trust gold more than paper denominations. And they are acting on that belief at a pace this system has never produced before. The U.S. economy shed 92,000 jobs in February. The unemployment rate reached 4.4%. Manufacturing contracted in 23 of the last 25 months, the longest sustained contraction since 2008. Consumer price inflation printed at 2.4% year over year, and that data captures 0 days of the commodity price surge. Not one. You now have the same information they have. 5 legal government-regulated strategies to move portions of your wealth outside the reach of institutional risk, automated selling pressure, and an inflation rate actively outpacing what your bank pays you every single month. Raw land, zero bank, zero mortgage, zero counterparty. Physical precious metals, the assets central banks are accumulating at triple their historical pace. Treasury Direct, government-guaranteed returns at more than 10 times the national bank average. Self-directed precious metals, IRA, physical gold growing permanently tax-free inside a Roth. Allocated foreign vault, physical gold outside U.S. jurisdiction, fully legal, IRS reportable. The window, I-bonds at 4.03% available through April 30th. Gold below its 2026 all-time high of $5,500. Roth conversion rates locked in today before Congress addresses $38 trillion in debt. Hit subscribe. The number on the screen is not the real number. The real number is what it buys. Stay sharp, stay positioned. I will see you in the next one.